If you're thinking about buying a property or you're already a landlord, then you're in the right place, because I'm going to be answering a debate that's been going on for years. Is buy-to-let still worth it, or has it died out completely? Is buy-to-let still viable despite everything changing right now with renters' rights? What the UK property market is actually doing using the latest Rightmove data that was released just a few days ago. And I'll show you how other landlords are really feeling about this all. So that being Facebook, Reddit, real opinions. If that's not enough, I'm going to be revealing the best areas to invest in the UK right now in terms of buy-to-let, starting with the worst, ending on the best. So stick around. Let's get started. I want to start with something that I saw in a landlord Facebook group recently. One of the landlords on there shared her take on all the buy-to-let is dead noise. So she says, buy-to-let isn't dead, but the days of let and forget certainly are. And that's a fair point. I'd actually agree with a lot of the post. In my opinion, buy-to-let hasn't died, it's simply evolved. And that really spoke out to me. But then there's this comment. So someone with 9 properties saying that they feel it's definitely a dying market, slowly selling, switching to dividend ETFs. That's got the most likes in terms of comments, with 17 likes. And I'm not here to say that anyone is wrong. 9 properties is serious money. That takes some serious knowledge, graft. But if the numbers don't work for them, then of course getting out is a rational decision. The question I've asked myself is the market actually dying, or just is their strategy dying? Because that's 2 different things. And it's not just Facebook. Over on Reddit, in the UK landlords sort of section, you've got threads with hundreds of comments. Does anyone actually have anything positive to say about being a landlord anymore? And that's got 123 comments. The sentiment right now is cautious at best. People are genuinely fearful at worst, and I get it. But what I want to know is, if you strip away the bad strategies, the bad timing, the over-leveraged purchases, what's actually left? What does the market look like when you look at it? But before we get into the market data, let me explain why I choose to invest in property over a bank account in the first place. Because it's the foundation. If you don't understand this bit, then the rest of the video won't really matter. But let's say you've got £25,000 sitting in savings at current interest rates. Best easy access account you might find, let's say 4.5%, maybe 5%. Let's call it about £1,100–1,200 in interest. Not nothing, but not life-changing either. And depending on how you do it, that's before tax as well. Now, taking that same £25,000 and using it as a 25% deposit, you now have a £100,000 property. That's leverage. The bank lends you the other 75%, and the bit that most people completely miss, the rent covers the mortgage cost itself. So your £25,000 is working, so's the bank's other £75,000. If you've got a house that's worth £100,000 and that goes up 8%, that's £108,000. You're earning interest on the full value of the property, even though you've only put in £25,000. Yes, there are going to be other costs involved. It's massively oversimplified and it is going to be a struggle. But this just been an example of why this is what I look at instead. Historically, property values, they're consistently going up. You have one buy-to-let that produces a monthly profit, let's say 200, 250 after all costs. You save that. After a few years, you remortgage the property, pull the equity out. Now you've got a deposit for your second property. Now you've got 2 assets growing in value in the same way. 2 assets with a monthly profit. You repeat, and quickly 2 becomes 3, 3 becomes 4, compounds and builds. And that kind of leverage you don't really tend to find in other types of investment. But that's where it gets even more interesting, because inflation is actually working in your favour. Your mortgage debt, your mortgage amount is either going to slowly drop or it's going to stay the same, and you'll have a fixed rate potentially as well. But your rent's going to go up with inflation. So over time, you'll find your mortgage payment stays around about the same, but your rental income, it's going to increase year on year. The gap between what you collect and what you pay out, that gap's going to get bigger. Every year, inflation erodes the real cost of your debt. Let's say a mortgage from 2005, the value of the pound was very different in 2005 compared to now. The value of debt going down over time is probably the one upside to inflation. It's just a shame there's so many downsides. I am simplifying. I can't wait to see the comments. Of course, there are costs, there's tax, there's voids, and we'll get to it. But the core mechanic is undeniable. You're basically using someone else's money to buy a property, which pays you every month. That asset grows over time and inflation makes your debt cheaper with every year that passes. That's the machine behind it. That's why people do it. But, and this is the question that the whole video is about, does that machine still work right now? 2026, with mortgage rates where they are, with all the regulatory changes. Let me show you what the data actually says. And fair warning, the latest numbers might surprise you. So the June 2026 Rightmove House Price Index released a few days ago, but the headline is that the average asking price for properties is down 0.6% last month, down about £2,113. And the context that matters, it's the biggest June fall in 14 years, because usually June will give us a little bit of a rise. And over the last decade, the average June has been up about 0.1%. This year, down 0.6. Now, if you're a landlord or you're thinking about becoming one, that headline might put you off a little bit, but bear with me because there's a couple of things that I take away from this. So Rightmove's own data shows that prices have fallen across all southern England regions, London and Wales. But if you're looking at the North, the Midlands, Scotland, they've held up much better compared to last year. So what I'm saying is the national average is being dragged down by London, the southeast. But if you're investing in the north, it's completely different. Sorry, London. The other thing I take away is if property prices have fallen, likelihood is that there is more properties on the market than usual. What that means is people have more choice. If they can't get one property, they're not willing to pay more or overpay towards getting the home of their dreams because there's so much choice available. And Rightmove's data backs this up as well. People are currently buying less than usual, down to a combination of different factors. Firstly, world events. We had a heat wave in May, which confuses everyone who's British when it happens. Sporting events, hot holidays, you've got the World Cup, which means people are buying less. And that means that the number of homes for sale is at historically high levels for this time of year. What that means for you is more opportunity. We're currently in a buyer's market. There's more stock for you to choose from, more variety, more negotiating power. On top of that, mortgage rates have actually improved this month. The average 2-year fixed rate fell from 5.18% to 5.07%, which is only about £30 a month on the average mortgage, but it does speak to the direction that we're going in. The Bank of England base rate's 3.75%. And the market is pricing in another cut this year. And if it comes through, obviously mortgage rates, buy-to-let rates, they'll all follow. Things are different, things are changing, but the market hasn't lost its confidence. So what we're seeing is prices are a little bit weaker in the south. They're holding strong up north. You've got more rental properties than ever to choose from, which means deals are there if you know where to look. Mortgage rates, it's very slow, but they are getting there, all at a time when there's less rental properties available, so rent is naturally going to go up. So you've got loads of choice of properties, loads of negotiating power at a time when rents are going to go up. So the economics, the dynamics of landlords who stay, they're actually improving. The market isn't something that's broken. It's the lazy landlord strategy of, as was mentioned before, that set it and forget it strategy. That's now gone, and I think that's a good thing. So I know what you're thinking. What about the legal stuff? So the Renters' Rights Act, Section 21 being scrapped, the EPC deadlines, the government's attitude towards landlords. Let me give you my take on it. If you think about it, what other investment lets you put in, let's say, 25 grand, £30,000, and you get a return on investment of 12%? Or let's knock off tax, 10%. Let's knock off things going wrong, 8%, 7%. Let's call it 7%. But you're able to compound that into 2 properties, 4, because the property value is going up in price over time as rents and your profitability also go up. Are there decent alternatives? I can't really find one. And I've looked. Stocks, you don't get monthly income unless you're selling, and you've got to be selling at the right time. Crypto, no income at all, and you might lose a little bit of sleep at night as well. Bank account, already covered. You're treading water at best. With this, is it harder than it was 5 years ago? Yes, definitely. The days of buying something with a front door and just watching money rolling in, that's gone. And honestly, it should be. That wasn't investing, it was just gambling with a mortgage. What's happened over the last 3-4 years, all that's done with rates normalising, Section 21 being abolished, EPC targets, it's done one thing really effectively, and that's pushed people out who weren't serious, either that or didn't position themselves strong enough at the start. What's left now is an asset class that rewards people that actually do the work, who buy in the right area, who run the numbers before they exchange, who treat it like a business, not a hobby. The Renters' Rights Act gets brought up constantly. Yes, it changes things. It removes Section 21. It changes the eviction process. But it doesn't stop you from managing a property well. That's from screening your tenants properly, building a portfolio that cash flows. But what it stops you from doing is being a bad landlord. And I'm okay with that. That's a change that I'm sure a lot of people would agree that the industry does need. The EPC stuff, the push to get properties to a C rating by 2030, of course that's a cost. But it's a cost that if you're buying, you can price it in, you can negotiate on the purchase price. If you already own a property, you can see if there's any exemptions, any grants. And if you do the work, then you've got a more energy efficient property that's more attractive to tenants, it's more valuable, it's just an investment in your asset. My honest verdict, and this is coming from someone who's actively buying in this market, is that buy-to-let is still the best wealth building tool that most people have access to. But that's only if you're buying in the right places with the right strategies. And the right places is what I want to show you right now. Running through these in order, starting with where I'd personally not be investing, going from worst to best. First of all, we have central London. So yields are lower than what you can find. Entry costs, very high. And at today's mortgage rates, the cash flow, it isn't there. So if you're a beginner with a small deposit, it's an area I'd stay away from. I wouldn't touch it with a barge pole. And now for the southeast and southwest. So property prices here, they are a little bit higher. Just a lot of competition from home buyers. Yes, you can find some pockets or commuter towns that actually work, like Southampton, which is offering quite strong yields. But as an overall strategy, it's something you want to be a bit careful because the margins are quite thin. Now, this is where things get a little bit more interesting in the Midlands. So yields here are healthy. Entry prices are realistic. I know some particular hotspots being Nottingham, Leicester, Derby. You've got some big employers in these cities with huge student populations and an undeniable rental demand. So a solid place to start a portfolio or build one up. Up next, Yorkshire and the Humber, which is an absolute goldmine if you are on a little bit more of a budget. It's where I'd feel a lot more comfortable in terms of yield, with buy-to-let being more competitive. Property prices here are lower than the Midlands. We're talking £80,000 to £120,000 for a solid rentable property. And then you've got cities like Leeds, Hull, which are driven by massive regeneration projects with lots of tenant demand. It's easily one of the most squared away, hidden capital growth opportunities that you could have at the minute. If you want the full package, so good rental yield, long-term capital growth, for me, the Northwest takes the crown. You've got Manchester and Liverpool, absolute powerhouses, again, regeneration projects. But you've got like Preston and Burnley, which are also areas you wouldn't necessarily consider, but they're actually coming to be quite competitive. In the south, you've got property prices struggling a little bit. Up north, they're holding strong. People are moving up there as they're able to work from home more with technology. Quick disclaimer, this isn't financial advice. I'm not a financial advisor. This is what I'm seeing as someone who's actively buying in this market right now. You do need to do your own research, but if you're asking me where I'd start in the north. Actually, it is where I started. If you're sitting on the fence, or if you've been waiting for the right time, I'd honestly suggest that waiting another year, watching property prices creep up, watching rents get higher, it might cost you more than the higher mortgage rate maybe that you're worried about. If you're quite new to the idea, I know it's daunting, so the best piece of advice that I wish I'd gotten at that stage was take it one little step at a time. Step one, pick the area that you want to invest in or think would work well. Maybe have a look, see if it's profitable, and then just take it little by little. From there, it's speaking to a mortgage broker, going for a viewing, looking for anything that you think might be a red flag. Let me know your thoughts down in the comments, whether you disagree with absolutely everything that I've said, but I'd love to know where you stand. Are you buying? Are you selling? But I read every single comment. If you want to see more of this, hit the subscribe button. I document my own journey through all of this, the wins, the many, many mistakes, and I share everything along the way. Hit the like button if you really enjoyed it. That would mean the absolute world to me too. But thanks so much for watching, and I'll see you in the next one. Bye-bye.